And thanks for joining me here at NTD Business. I'm Don Ma. A quick overview of the markets. Wall Street is taking higher Thursday as investors consider both the upside and downside of the latest signals that the U.S. economy remains stronger than previously feared. Yields were jumping in the bond market as well after data showed the U.S. economy grew at a 2% annual rate in the first 3 months of the year. And another report said fewer workers applied for unemployment benefits last week than expected. This is a sign that the job market remains remarkably solid despite much higher interest rates, which were meant to slow down the overall economy. On one hand, the data are a positive for investors because they suggest the economy can keep growing and support profits for companies, of course, which are the lifeblood of the stock market. But on the other hand, they could also mean the Federal Reserve will see the economy as strong enough to keep hiking interest rates to drive down inflation. Thursday's data pushed up expectations among traders for the Fed to raise rates twice more this year, according to data from the CME Group. It's what the Fed has been suggesting it would do, but Wall Street has been slow to accept it. Earlier, it had been mostly penciling in just one increase. Meanwhile, Tesla is set to hit another record quarter with its China sales, and this is despite facing local competitors eating into its share in the world's largest auto market. An analyst with China Merchants Bank International Securities forecasted that Tesla would sell 155,000 cars in China during April to June. This is an increase of 13% from its record first quarter. China is Tesla's second largest market after North America and home to its biggest factory. It slashed prices for its two aging models at the beginning of the year to boost sales and started a price war with competitors, including BYD, following to offer discounts or launch new lower-priced models. And as its Shanghai plant achieves its annual production capacity of over 1 million units, Tesla is selling into new markets in the region. That's including Thailand and Malaysia with China-made cars. As I mentioned earlier, last quarter's GDP has been revised. The U.S. economy grew at a 2% annual pace from January through March, according to the Commerce Department. It's a sharp upgrade from its previous estimate of 1.3% rate. Thursday's report on the nation's gross domestic product showed why the economy has so far managed to defy expectations of upcoming recession. And a big reason is that consumers continue to spend. Consumer spending accounts for about 70% of the economy, and it rose at a 4.2% annual rate in the January-March quarter. Now, this is the most since April-June 2021. And at the same time, the job market is still strong. The Labor Department reported that the number of Americans applying for unemployment benefits fell last week by 26,000. But all this doesn't mean that a recession is entirely off the table. The chief U.S. economist at High Frequency Economics said in a research note that, quote, "While the economy has outperformed expectations, our base case is that the lagged and cumulative effects of restrictive interest rates will slow the pace of activity going forward." And finally, big U.S. banks passed the Federal Reserve's annual health check on Wednesday. This is a vote of confidence for a sector still recovering from turmoil earlier this year. The Fed's bank stress test exercise showed lenders have enough capital to weather a severe economic slump. That's including banks like JP Morgan, Bank of America, Citigroup, Wells Fargo, Morgan Stanley, and Goldman Sachs. The 23 banks have more than $100 million each in assets, and they would suffer a combined $541 billion in losses under the Fed's severe economic downturn scenario. This is one of its toughest yet. But even so, the banks would still have over twice the amount of capital required. While the results look strong and were celebrated by the industry, critics warned the results paint an overly optimistic picture because just months ago, the government was forced to intervene to protect depositors during the banking turmoil. Among the top performers were Charles Schwab Corp. And Deutsche Bank's U.S. operations, while regional lenders, Citizen Financial Corp. And U.S. Bank Corp. Were the laggards of the pack. Fed Vice Chair for Supervision Michael Barr said the results showed the banking system was strong and resilient. But he also emphasized it was just one measure of the sector's health. He says, quote, "We should remain humble about how risks can arise and continue our work to ensure that banks are resilient to a range of economic scenarios. That's including market shocks and other stresses." Industry officials were quick to cheer the results, which they said showed there was no need for Barr to impose tougher rules, which he has pledged to do in the past. For further analysis, here to talk to me is Joseph Trevisani, senior analyst at FX Street. Now, the Federal Reserve bank stress test, it seems all 23 banks passed. It seems to align with what Powell said, that the banks are sound and resilient. What do you think?
Of course it is, and it actually reinforces that. One thing I think that's important about these stress tests this time is that they have posited a pretty realistic scenario, particularly involving commercial real estate, that would put banks' loan portfolio under stress. So for that much, I think they've got a pretty good handle on what might possibly happen if we enter a recession or enter a downturn.
And they were testing whether they would have enough capital for lending to continue in these scenarios. But if we're in a recession, I mean, are consumers going to be borrowing that much?
Well, I don't know it's so much that consumers are going to be borrowing that much. I mean, what we've seen in the past year or so is that consumers have dipped into their savings and their credit card accounts, using them to keep their levels of spending intact, primarily because of inflation and the bite that's taking. It's certainly not because of the job market, which remains strong, and you can find a job if you lose one or if you want a job. So yes, I think that would be a big area for the Fed to concern themselves with, especially for banks whose portfolio and whose profits are based largely, like Capital One, on a very large consumer credit portfolio.
Now, what would be the consequences if, let's say, the bank didn't pass this stress test? Would that mean in a realistic scenario, in a downturn, the bank would default on its obligations?
It's possible. I mean, we've seen recently what happens when the banks don't have enough capital to support their various endeavors with SVB and Signature. So that's the basic scenario where you get something like that happening. The value of their assets decline dramatically, and they don't have enough capital to support their efforts. What the financial system more or less depends on are these large banks, the ones that used to be called money center banks, but you don't hear that phrase much anymore. Because as with the recent crisis in California, the recent problems in California wasn't really a crisis, large banks are the ones who are called upon to bail out or to buy, if you will, the weaker members of the banking community. So that's the reason that the Fed focuses on these large banks.
How aligned are these tests to reality, do you think?
Well, the problem with scenarios on the future is that although you can project some things quite logically, you can never, of course, know the future. When a crisis hits, as the crisis back in 2008, it hit from an unexpected direction. You could easily make the argument for 2008 that some people actually knew that this was a problem, and there are a number of stories about that and also reality about that where several traders in various positions saw this coming. But for most cases, a scenario like that is unusual. What hits is unknown. So I think the Fed has done a pretty good job, as I said earlier, primarily focusing on, or at least bringing up, the potential problems in the commercial real estate area. That is something we know about. That's something we know will worsen in a recession. The Fed does what it can predicting into the future, but from so many other areas we know as well, nobody predicts the future very well, including the Fed.
So it seems like the situation with commercial real estate is on the Fed's radar, the fact that they tested for this.
Yes, I think it's an important factor in it, because that is not only is that an area which would worsen a good deal in a recession, it's one that's getting worse right now as it is, because as these centers of many cities, New York is a good example where I live, the buildings, San Francisco is another example. Commercial buildings in the financial district and in the office areas have much lower than normal occupancy rates. Those occupancy rates bring back, of course, money for the loan and the people who own the building. So the entire structure that's based on 80, 90% occupancy rates comes under stress. And that's something which is happening right now and will continue to happen regardless of whether or not we end up in a recession.
So, of course, even though they passed, these banks passed the test, that doesn't mean they're not going to be impacted when a downturn hits or however severe it may be. What would those impacts be?
Well, the impacts, I think, are what we're seeing here, and they've highlighted some of them. Of the ones that we know, I think the biggest problem could come from the two areas that the Fed actually has highlighted. Commercial real estate. Now, of course, the exposure to commercial real estate varies from bank to bank. The ones that are more exposed to commercial real estate in urban areas and urban centers that have much lower occupancy rates are the ones that are going to have problems with that part of the portfolio. Other banks, such as Capital One, which are heavily dependent on consumer credit, that is an area which will certainly be impacted from a recession. Consumers will pull back and stop spending, and defaults will rise. So the impact varies from bank to bank, depending on how their asset structure is formulated.
Maybe as well, you can provide some context for these stress tests. What's the fear here?
Well, the fear here is that, as in 2008, as in a very small sense, what we saw in California around Silicon Valley, is that the banks are impacted so that they have to pull back on their lending, but more so, they have problems with maintaining capital adequacy. That's the real problem. What you do is you bump up against the federal limits for capital adequacy, that you don't have enough money on hand to satisfy the regulations. That's the biggest problem. That's what causes banks to go under, because they can no longer satisfy what the feds require in case. Because look, if their capital diminishes so much that they can't satisfy credit demand, I mean, they can't satisfy what customers try to do with withdrawals, which is what we saw with SVB, then the entire bank structure starts to collapse for that particular bank.
I mean, let's say JP Morgan, for example. I mean, such a large bank, is it even possible? Let's say we had a bank run. Is that even possible that the bank would fail?
No, because as we know, one of the Fed's primary jobs is the lender of last resort. And if any bank such as that became a problem, one, the fear would be very great, but the Fed would step in immediately, probably before that even became evident, hopefully, and provide enough capital. After all, the Fed can create as much capital as it wants and dole it out to the banks that need it. So that is not really a scenario, because if JP Morgan is under stress to a degree that the Fed is worried about it, then there is an enormous problem in the economy. Banks never have enough capital on hand to handle all of the deposits if they're called on, if people start withdrawing them. So as long as confidence is maintained, then banks function as they would normally. So I don't think it's really a problem, because the Fed will take care of that, but it certainly will affect some of the smaller banks that may not have that kind of backstop.
And on this topic, I mean, banks fail all the time, smaller banks. So the fact that confidence is shaken, I mean, do you think that that's something more sentimental than rational?
Rational, that's a good question. Markets tend to be psychological, but that doesn't mean they're rational. And this is necessarily a market function as well. So no, I wouldn't say it's not rational, but it is something that does happen. The U.S. banking system has had deposit insurance for many, many years now, back to the Roosevelt administration. So that has taken care of a large portion of what smaller depositors fear. They know they will have their money. The problem with SVB, of course, and some of those other banks, was that a large portion of their deposits were above the $250,000 guarantee. That, in a very logical sense, and you would say a rational sense, the reaction of the depositors to take their money out was very logical, was very correct. It was at risk, and they were not willing to take that kind of risk. So confidence, I think, in the whole system is one of the things that we're talking about. It doesn't necessarily translate to confidence in every particular bank, every particular institution.
All right, let's just end on this. The 23 banks, they all passed the stress test.
Yes.
We should be confident about this. The takeaway here is we should be confident about the U.S. banking system.
Yes, I would agree with that. The Fed is doing its job. It's certainly putting these banks to a very rigorous test. So I think for the confidence of these banks in the market, yes, I think you're absolutely correct. We can be sure about that. The problem with everything and with life, if you will, certainly in economic life, is that oftentimes the system gets hit by things which are unexpected. By definition, if it's unexpected, we can't be sure what's actually coming. For what we see and what we know at the moment, yes, I think these stress tests provide a good window on what the banks are doing.
All right, thank you so much today. It's always great to speak with you.
Thank you very much for having me. It's always a pleasure.